For decades, the standard formula for retirement has been exactly the same. Work for 40 years, save aggressively, build a giant pile of money, and then slowly drain it until you die. The flaw with this approach is that it ties your entire sense of security to your net worth. When the stock market drops by 20%, your pile shrinks, and you immediately start worrying if that giant number will actually be enough to last. Measuring true wealth by the creation of predictable cash flow changes your focus from accumulating a giant number to securing your daily life. This chart shows how yield can be more valuable than share portfolio size. On the left, a $2 million portfolio generating only $20,000 a year in income. On the right, an $800,000 portfolio that produces $60,000 a year. This video details the specific steps to build an automated income machine using proven dividend-paying assets to steadily replace your salary. Owning a system that reliably drops cash into your account every month provides security that a static pile of wealth cannot match, regardless of what the stock market is doing. Retirement begins the exact moment your passive income covers your essential living expenses. To find that starting line, you need to calculate your lifestyle floor. This is the baseline amount of money required to keep your life running, including only your strictly essential monthly costs. You calculate this by totaling housing, food, utilities, transportation, and insurance. If those basic survival costs add up to $3,000, then $3,000 a month is your lifestyle floor. That specific sum becomes the definitive monthly target your automated income machine must eventually generate. Hitting this floor allows you to treat employment as a choice, knowing your survival is already funded by your assets. The foundational asset class for this strategy is the Dividend Aristocrat. These are companies in the S&P 500 index that have increased their dividend payments every single year for at least 25 consecutive years. A long historical streak is not a guarantee of future safety. Large companies like Walgreens and AT&T were once aristocrats before cutting their dividends, hurting investors who relied purely on the past. Using Morningstar's concept of an economic moat helps filter for quality. A wide moat indicates a company has a significant competitive advantage that protects its earnings and its ability to keep paying dividends during a downturn. Once you identify these wide moat businesses, you should only purchase them when they are trading at a discount below their estimated fair value. This data table displays companies that currently pass both tests. Clorox, McCormick, and Brown-Forman all hold wide moat ratings and currently trade at price-to-fair value ratios below 1.0. Asset selection based on forward-looking competitive advantages and price discounts protects the stability of your cash flow. You can build this machine by manually picking individual aristocrats, or you can use a streamlined shortcut. Dividend exchange-traded funds, or ETFs, provide instant diversification. A single fund purchase gives you exposure to a broad basket of dividend-paying stocks, which drastically reduces your risk. This comparison matrix shows the NOBL ETF, which tracks strict aristocrats, alongside alternatives like SCHD, SDY, and VIC. These funds often prioritize high-quality dividend growth over a simple 25-year unbroken streak. A corporate failure won't destroy your lifestyle floor when you use a diversified ETF engine to power the machine. The mechanical setup requires logging into a brokerage to enable automated recurring investments and a dividend reinvestment plan, or DRIP. This combination creates a self-sustaining loop. A portion of your salary is automatically deposited to buy assets, which earn dividends, which are automatically reinvested to buy even more assets. Once the system is live, you must act as an absentee business owner, strictly forbidding yourself from manual tinkering or reacting to daily headlines. This discipline faces its hardest test during a stock market crash, when falling prices cause most people to panic. During a crash, the dividend yield on these assets naturally spikes as the share price drops. For the income investor, this simply means inventory has gone on sale. Stripping emotion out of the process allows market crashes to accelerate the compounding of your income rather than threatening it. This approach relies on 4 steps: calculating your target floor, applying the moat filter, selecting the ETF engine, and automating the system to run like a water wheel. Capital exists to buy back your life in the present. True wealth is ultimately measured by how much of your time belongs to you, rather than the numbers on a screen. You can take action today by calculating your lifestyle floor and setting up your first $50 automatic weekly deposit. Setting this sequence in motion is the moment you stop working for money and force your money to work for you.